Greetings and welcome back to the Global Business Channel. Thank you for joining us today. In this video, we'll be discussing the share capital of private and public companies. First, we'll explain what share capital is. Second, we'll delve deeper into the concepts related to share capital. Third, we'll analyze the different types of share capital used in various contexts. Fourth, we'll answer a couple of commonly asked questions about share capital. And lastly, we'll look at some of the provisions of share and stated capital regarding the Mauritius Companies Act 2001, since that is the country in which I operate. We publish weekly videos covering topics related to offshore global business, corporate, financial, and compliance sectors. Therefore, we encourage you to subscribe to the channel and give this video a thumbs up if you find these topics interesting. Without further delay, let's get started with today's video. So, what is a company's share capital? The share capital is the money a company raises by issuing common or preferred stock, which are called ordinary and preference shares in commonwealth countries respectively. And those are the definitions we shall be using throughout this video. To shareholders or investors. The amount of share capital or equity financing a company has can change over time with additional public or private offerings. The term share capital can have slightly different meanings depending on the context. Financial accountants typically use a narrower definition, referring to the total amount raised by the company through the sale or issue of shares, as shown on the balance sheets of public and/or private companies. Simply put, the share capital of a company is the money it raises by issuing shares to investors for public companies and shareholders for private companies. Share capital is recorded by a company on its balance sheet within the shareholders' equity section. The information may be divided into separate line items based on the source of funds. These typically include lines for ordinary shares or preference shares and additional paid-in capital. Common or preference shares are reported at their par value at the time of sale in most instances. However, that is not always the case. We published a video on the differences between par value and no par value shares, so we encourage you to watch this video for added context and understanding. In modern business, the par value or face value is generally a nominal figure. Any amount received by the company above the par value is reported as additional paid-in capital. The amount of share capital reported by a company includes only the payments received for shares purchased directly from the company. Subsequent sales or issues and purchases of those shares, as well as fluctuations in their market prices, do not impact the company's share capital. This, of course, is in relation to publicly listed companies. A company may choose to conduct additional public offerings after its initial public offering, otherwise known as an IPO. The proceeds from these subsequent sales would increase the share capital on its balance sheet. The term share capital can have slightly different meanings depending on the context. When referring to the amount of money a company can legally raise through the sale of stocks or shares, there are various categories of share capital. Generally, financial accountants use a much narrower definition. Let's take a look at the four most common prevalent ones. Authorized share capital. Before a company can raise equity capital, it must obtain permission to sell its stock or shares. The company needs to specify the total amount of equity it aims to raise and the base value of its shares, known as the par value. The maximum amount of share capital a company is allowed to raise is referred to as its authorized capital. This does not limit the number of shares a company may issue, but it sets a ceiling on the total amount of money that can be raised from selling those shares. For instance, if a company is authorized to raise $10 million with a par value of $1 per share, it can issue and sell up to 10 million shares of stock. Issued share capital. The total value of the shares a company chooses to sell to investors or shareholders is known as its issued share capital. The par value of the issued share capital cannot exceed the authorized share capital. In some regions, companies can issue call-up shares to investors or shareholders with the understanding that they will be paid in full at a later date. Outstanding share capital, or stated capital, includes the total value of all shares that a company issues, excluding the shares it bought back, if any. For context, shares bought back or repurchased by a company are called treasury shares. So, even if a share has been issued to insiders or promoters, it is still part of the outstanding share capital. The term stated capital is the share capital structure used in the country I work in, being Mauritius. Share capital on a balance sheet. The technical accounting definition of share capital is the par value or consideration value of all equity shares or securities, including ordinary and preference shares, sold to shareholders or investors. However, non-accountants often include the stock price in excess of par value in the share capital calculation. Typically, the par value of shares is nominal, usually $1 or less. Therefore, the difference between the par value and the actual sale price, known as paid-in capital, is usually substantial. Nevertheless, it is not technically part of share capital or restricted by authorized capital limits. For example, if a company issues 1,000 shares with a par value of $1 each and sells them for $25 each, the accountant will record $1,000 as share capital and the remaining $24,000 as additional paid-in capital. This is how it would appear on the balance sheet. Let's now take a look at a couple of commonly encountered questions surrounding share capital. Does share capital equal equity? Share capital represents a portion of a company's equity obtained through the issuance of ordinary or preference shares, distinguishing it from other forms of equity accounts. And number two, what other terms refer to share capital? Share capital may also be known as shareholders' capital, equity capital, contributed capital, stated capital, or paid-in capital. Let's now take a moment to go through the major provisions of the Mauritius Companies Act 2001 regarding share capital, which in our legislation is referred to as the stated capital of companies. I will be summarizing the relevant sections, but do take a moment to pause the video to read through them, if you will. Section 7 concerns stated capital, and it states in subsection 1, except as provided in section 62, which pertains to the reduction of a company's stated capital concerning a class or classes of no par value shares issued by a company encompasses the aggregate of all amounts received by the company or owed and payable to the company regarding A, the issuance of the shares, and B, calls made on the shares. Subsection 2 stipulates that except as provided in section 62, stated capital relating to a class or classes of par value shares issued by a company includes the total of all amounts received by the company or owed and payable to the company concerning A, the nominal paid-up value of the shares, and B, the share premiums paid to the company concerning those shares and mandated to be transferred to the share premium account under section 48, which addresses share premium accounts. Subsection 3 discloses that when a share is issued for consideration other than cash, The board shall, in accordance with Section 57, which concerns shares not paid for in cash, determine the cash value of that consideration for the purposes of subsection 1 or 2 as applicable. And finally, subsection 4 asserts that if a share carries an obligation besides a duty to pay calls, and that obligation is fulfilled by the shareholder, A, the board shall assess the cash value, if any, of that fulfillment, and B, the cash value of that fulfillment shall be regarded as a call paid on the share for the purposes of subsection 1 or 2 as applicable. Section 48, which concerns the stated capital and share premium accounts, states in subsection 1 that each class of shares issued by a company must have a designated stated capital account, where the company records the stated capital associated with that particular class of shares. Subsection 2 stipulates that a company may only reduce its stated capital in accordance with the provisions outlined in Section 62, which, as mentioned earlier, pertains to the reduction of a company's stated capital. Subsection 3 reveals that the regulations within the Companies Act 2001 concerning stated capital do not extend to a company categorized as an investment company, including an authorized mutual fund. Subsection 4 asserts that unless a company holds a global business license or is licensed as an authorized company by the Financial Services Commission of Mauritius, the stated capital of the company should be denominated in Mauritian currency. However, if written approval to express the stated capital in another currency is obtained from the Mauritius Registrar of Companies, it can be expressed in that currency, following the same procedure as outlined in Section 213. Subsection 5 states that when shares with a par value are issued at a premium, whether through cash or other means, the total premium amount or value on those shares must be moved to an account named the share premium account. The regulations within this act regarding the company's stated capital and the reduction of its share capital will then be applicable. Subsection 6 stipulates that if shares with a par value are issued in exchange for a non-cash consideration and the value of that consideration exceeds the par value of the shares, the surplus between the par value and the acquired value of the shares shall be moved to the share premium account. Subsection 7 argues that for shares with a par value, the company has the option to utilize the share premium account despite the provisions of subsection 5 to fully pay up the shares to be issued to shareholders as fully paid shares. And finally, subsection 8 asserts that the stated capital account, which includes the share premium account for shares with a par value, can be utilized by the company to write off A, the initial expenses of the company, or B, the costs incurred in creating or issuing such shares, including commissions paid, provided that the directors are convinced that the company will promptly meet the solvency test after such utilization, regardless of the provisions in subsection 5. Finally, off to the last section of the Companies Act regarding stated capital, we have Section 62 regarding the reduction in a company's stated capital. Subsection 1 states that unless restricted by subsection 3, a company has the authority to decrease its stated capital to any amount it deems appropriate through a special resolution of the shareholders, meaning acquiring the assent of at least 75% of those entitled to vote. Subsection 2 stipulates that notification to the public regarding the intended reduction of a company's stated capital must be provided at least 30 days before the resolution to reduce the stated capital is enacted. However, as per the 13th schedule of the Act, this section is not applicable for a company that holds a global business license or is licensed as an authorized company by the Financial Services Commission of Mauritius. Subsection 3 asserts that a company has the option to enter into a written agreement with a creditor stipulating that it will not decrease its stated capital, A, below a predetermined threshold without the creditor's prior consent, or B, unless certain conditions are met at the time of the reduction. Subsection 4 declares that a resolution of the shareholders to diminish the stated capital that contravenes any agreement mentioned in subsection 3 shall be deemed invalid and without any legal effect. Subsection 5 discloses that the company must refrain from undertaking any action, A, to nullify or diminish a liability concerning any unpaid amount on a share, or B, to reduce its stated capital for any reason, except for declaring a reduction in stated capital not proportional to its asset value, unless the directors have reasonable grounds to believe that following such action, the company will promptly meet the solvency test. Subsection 6 states that in situations where a shareholder opts to redeem a share under Section 79 pertaining to redemption at the option of a shareholder or on a predetermined date as per Section 80 pertaining to a redemption at a fixed date, or B, the company acquires a share under Section 68 pertaining to a company purchasing or redeeming its own shares, and the board determines that due to this redemption or acquisition, the company would otherwise not meet the solvency test, then 1. The board must decide that the stated capital of the company will be decreased by the amount that would cause the company to fail the solvency test. Number 2, the board's decision will be enforced regardless of subsections 1, 2, 3. And finally, subsection 7 stipulates that within 14 days following the reduction, a company must notify the registrar of companies of the reduction, detailing the reduced amount of its stated capital, along with the amount of reduction. In summary, the share capital represents the funds raised by a company through the issuance of ordinary or preference shares. Authorized share capital denotes the maximum amount a company can raise through shares. Issued share capital reflects the total number of shares a company decides to offer to investors or shareholders. To raise more equity and expand its share capital, a company can seek approval from its board of directors or shareholders to issue and sell more shares. That's it for today's video on the share capital of private and public companies. Thank you so much for sticking around until the end. Your support means a lot to us, and we hope you found the information, insights, and key points valuable. We'll continue to share informative content every week, so do not hesitate to return to the Global Business Channel for insightful videos on the offshore, global, compliance, and financial services sectors. Take care, stay safe, and we'll catch you in the next one. Cheers, guys.